Glad to be online here today. Thank you everybody for joining us. In the interesting market times we've been through this year with economic changes and government policy changes and unprecedented tariffs, there has been some concern about market performance and the outlook and whatnot. So we have talked about that a little bit in a prior webinar and of course on one-on-one meetings. But today I just wanted to take a bigger step back and just kind of look at some lessons we can learn from history of how the markets typically have behaved during and after bear markets. And, just looking back over time, since 1972, the last 50 years, there's been three very significant bear markets. So just wanted to go through those and just see about some investing lessons that we can learn from history. So, that's what we're going to take care of today. And if you have any questions along the way, just feel free to jump in and let us know that. So we'll kind of walk through, a little bit of information on these markets now. So, we know that history, does not necessarily predict, the future, so to speak. We know that because there are no facts about the future. The future is unwritten. However, as President Truman said, the only thing new in the world is the history that you don't know. So we're going to kind of walk through a little bit of lessons we can learn from that and maybe glean what might lie ahead for us all. So if anyone here was born before January the 10th, 1973, and from the crowd that I know, that's all but a couple of us, you've already lived through three episodes in which the broad U.S. stock market has went down by roughly half. So that's very real declines in the stock market, very substantial, very disconcerting. The three great bear markets of the last half century occurred back in the 1970s, 2000, 2002, and then again in 2007 and 2009. These declines were driven by very real crises, and that is a critical point to know that the underlying crises of those events were very real indeed, had to be dealt with. They weren't necessarily thunderstorms per se, like we typically see during the market years. They were more like hurricanes. So we're going to walk through really just what happened during those times. So just looking back at the first one, January 1973 to October 1974, the S&P 500 declined 48% over that time period. This was the largest decline since the Great Depression up until that time. There's a lot of issues that happened there. You can see those on the screen. It was marked by a crescendo of crises, kind of that perfect storm of economic and financial, political, and even geopolitical issues there with Watergate kind of being the capstone there. So, if you just think back to what you were doing in that time period, you can see how life was happening all around you at the same time. I know for example, was not very old, I have to admit. I was about 5 or 6 years old during that time period, but I distinctly remember playing with my toys and action figures in the back of my mother's station wagon in the gas line at Treasure Island on Highway 41. So that's what that was like back then. We had a lot of belt tightening that we had to do to get through that deep recession and the gas lines and the high unemployment. Then moving on, it took a long time to get to the next one, which was March of 2000 to October of 2002. And there was quite a bit taking place during that time period. .com was probably the greatest stock market bubble of all time. I remember it was compared to the great tulip bubble in the Netherlands, way back in the 1600s. And the speculation that was happening there was definitely rampant in the U.S. stock market back in this time period. We had massive accounting issues, accounting scandals. After Enron's issues, nobody could really trust the numbers anymore. Nobody knew what to believe there. And then as we were barely starting to pull out of this .com bubble, we had 9/11, which just sent it down on another downward leg, after that. So it was a very tumultuous time in those markets. And just thinking back to, what we were all doing back then, even I remember, don't know if y'all do, but I remember, on December 31st, 1999, staying up till midnight to see if the whole world shut down when my computers didn't have 4 digits programmed in with Y2K. So we made it through that. And the times were definitely a challenge and took some belt tightening to get through, but also, took a lot of work in the economy to bring things back. Fast forward then to October of 07, merely 5 years after that last one, October of 07 to March of 2009, we have what everyone calls the Great Recession. And this was really the biggest one of the three. So down negative 57% over that time period, and in a real way, I believe that this market right there was this generation's basically their Great Depression type experience, the 1929 to 1932 type experience. We did not see, the droughts and the famines and the 25% unemployment that was rampant in the Great Depression. However, we did see high unemployment. We saw a massive real estate problem. A lot of financial companies went bankrupt and had to be forced to merge with others. There was a global financial crisis. Unemployment did peak at 10%, but the markets were down 57%. You know, so it was the biggest one I think in this generation of investors, so far. And again, we always heard from folks, this time it's different, and what is different is the crises that causes it, but was it really different? We're going to kind of walk through that and see really, what happened on the back end. So just looking backwards a little bit, back to 1972 through the end of 2024, I think it's interesting to note that the S&P 500 index is actually 50 times higher than where it was back then. So it's hard to believe that the index was actually only at 118, back in 1972, such a low number, but I remember seeing it break 1,000. I remember seeing it break 2,000. And here we sit today at, 5,881 at the end of the year. Earnings, meanwhile, you can really see have multiplied by 39 times. They were at 617 a share back then, and now we're basically at 243.32 at the end of the year, with earnings on the S&P 500 companies. So, the ultimate answer to the question, why have stock prices risen over time? It's pretty simple. It's because superior companies like those in the S&P 500 have increased their earnings. We typically say that, prices follow earnings, and that's exactly what's been happening long term in the investment markets. So just looking at, why have earnings gone up so much? It's really pretty straightforward. There's productivity growth, and then there's been innovation in the economy. Just looking at real GDP, per person, that's inflation adjusted gross domestic product, is a measure of the country's output. It helps that productivity growth is high, but it also helps that the U.S. population rose by 50%. We have more workers in the workforce, but really productivity is up over 2 times. And of course, innovation, this is just staggering to me, continues to roll. 8 of the 10 most valuable companies in the S&P 500 did not exist in 1972, which is pretty cool. So I had to go through the list to see what that looks like. Google is actually, 2 versions of Google are actually listed twice that make up the top 10. So if you count them as one company, number 11, JP Morgan Chase, could be considered our 10th holding. If you score it that way, then 7 of the 10 did not exist in 1972. So pretty interesting how that has happened. Apple, Nvidia, Microsoft, Amazon, Meta, Tesla, and those are the 7 that did not exist. The ones that were still in existence are JP Morgan Chase, Berkshire Hathaway, and believe it or not, Broadcom, founded in 1961, some of its predecessors. Dividends have also grown far ahead of inflation. As concerned as everyone always is about stock prices, in retirement, we do strive to live primarily on dividends first and on capital appreciation second. So just looking at the growth of dividends in the S&P 500 over that same time period back to 1972, the cash dividend of the S&P has increased 23-fold, whereas inflation has increased 7-fold. So dividends have outpaced inflation by a little over 3 to 1 over that 52-year time period. So that is, to me, the big story, is the rate at which dividend growth has outstripped inflation in the midst of these 3 major bear markets. Since the end of World War II, with dividends reinvested, what has been the longest time for the stock market to break even off of a bear market? Since we're discussing very large stock price declines, the time to recovery is a very legitimate concern. We hear that question quite a bit. If I can't afford to lose, I can't afford for the markets to be down. So, that's why we look at buckets in portfolios to have short-term and mid-term money as well that you could go to. But we always do hear the question, how long is this going to take? Do I have time for a market to recover? So looking back at that, the longest ever was actually the 5 years and 8 months between the last two bear markets, August of 2000 to April of 2006. That was the last time, the longest time for the bear market to get back to where it had started. When we look at all the major bear markets, which would be defined as like a 20% decline or more, within a year or within a top to bottom cycle, it's averages about 2 to 2.5 years to go from top to bottom and then back from bottom to top. So we're usually looking to have 2 to 3 years worth of expenses, not in the U.S. stock market, but off in a stable value type allocation. So you've got a safety net to go to. But that is the longest one. It's an interesting fact, and that's why I think most people, investors today, can be very nervous about stock investing because they remember that decade of the 2000s that was bookended by two of the worst bear markets we've experienced. So it's a very legitimate concern. So if there's one key idea that I think I really would like to make sure we can all try to remember today, it's that it's most valuable to hold our investments during a declining market. And really the reason is because as prices fall, things do seem to be getting worse, and they could be economically getting worse until the market finds a bottom. But historically speaking, declining prices have signaled better value in every aspect of our economic lives, obviously, except one, which would be our investments. So there's an old Wall Street saying, that says the stock exchange is the only place where when they have a big sale, everyone runs out of the store, they run for the exits. And that can definitely be true. But a patient long-term investor who understands how markets work typically will remain invested and look for opportunities. So we definitely like to look for opportunity when the prices of superior companies have been discounted significantly. So, where does this really leave us? It's the good investor Charles Munger, Warren Buffett's partner, basically summed it up. If you're going to be in the game for a long pool or a long run, which is the way to do it, be able to handle a 50% decline without fussing too much about it. Of course, that's a different generation. I think that's said a little more strongly than I would, say that. We don't want clients to fear that. We need clients to understand that from time to time, this significant of a market can take place. And that's why diversification is so important, because we don't know when that's going to happen. We know that it might happen at some point, probably will again. But typically your intra-year declines are around 15% or so, and most people can take care of that and with a good diversified portfolio. So some key takeaways I think we can learn, from these three bear markets and how they impact us as investors. And I'll just kind of read through these for y'all kind of word for word here a little bit. First up, the shares of even America's finest companies have experienced frequent declines in price. I think that goes without saying. We're all well aware of that. We did see a 10% decline this year when the tariff war really heated up. Some of these declines, though, driven by very real crises, have been quite significant. We never want to discount that is a real distinct possibility. But despite these setbacks, leading U.S. companies have continued to grow their earnings and dividends strongly over time. We do believe that once we know what the playing field looks like in the current economic environment, that the best companies of the United States and of the world are going to know how to navigate that landscape and will adjust accordingly. And it may take some time, but they will become profitable again, and we will see prices follow their earnings. So their shares have overcome even the deepest declines more rapidly than one might expect, and then have gone on to new heights. We can't have growth in the markets without a new high at some point. Doesn't happen all the time, but we do eventually reach those. So just always remember, past performance is really no guarantee of future results. We all know that. There are no facts about the future, but the choice really does always remain. We can believe either this time it's different, which it certainly was in those three crises. The crises of the days were different every single time. So we could believe that. and dismiss our investment thesis, liquidate our portfolios, our long-term equity holdings, or we can say, well, this too shall pass. I'm well diversified. And these are the four words, the message in history of this presentation is that this too shall pass. So we want to remain diversified in our portfolios that way, and just know that in the long run, companies will find a way to navigate the current environment. And if we happen to have another one of these, 50% bear markets, we'll be prepared for that and walk everyone through that, but make sure that there's safety nets in the portfolio to help mitigate that as well. So with that, thank you very much. Want to just open up for any questions and see if there's any commentary about what's happening right now or any questions that I'm happy to take.
Thanks, Mike, for your time and the presentation.
Absolutely.
There, it's informative, but it's interesting, this tariff tax deal. You wonder if some point in time there's almost a point of no return. It seems like Trump's wanting to gain dollars for the Treasury by tariffs and reduce tax. Who knows what this tax bill is going to be, but talking about cutting overtime, taxes on overtime. And if you reduce those taxes and then something happens on the tariffs, it's hard to go back and raise taxes on people. And it's really an uncertain environment to plan for the future, especially like drawing money out of these buckets.
Right.
IRAs, if you've got a taxable IRA, well, if the taxes go low, that's good. But if they're going to be higher when I start drawing Social Security and Jennifer has a pension, then maybe I should draw right now while it's a lower income. It's like all these things are moving, and it's hard for us as a little guy to plan.
It really is. It's a challenge. We usually try to plan on what we know, with current tax rules and whatnot. But like you said, right now it's all in play, so we're going to have to really pay attention to where this lands and what ends up passing and is approved, and then start making adjustments pretty quickly from there. Yeah, I agree. It's a very uncertain time. So tariffs are inflationary by definition. It's like you said, it's difficult to raise rates on one side, cut them on the other, try to bring manufacturing back to the States or to other countries. That takes a long time to turn that ship. You can't just build a plant overnight, right? So if inflation really becomes a problem, I suspect there'll have to be some other fiscal change or in policy, that where they have to trim some of this back to give some ease to the economy. So hopefully it won't be too sharp of a decline though. So we're hopeful. Hopefully they'll have this resolved by the end of the summer. This tax bill still sitting there trying to be worked out. So personally, I think they should have done that first. And gotten that taken care of, because it does sunset at the end of the year, but we have to just see where they land it, and then we can start making plans. Absolutely. Well, y'all, thank you so much. We know that these times can be turbulent. It thankfully has not been a hurricane of a storm so far. It's been more of a thunderstorm this year. We do like to have unhurried conversations about these things. So if at any point anyone wants to talk with us further, please just shoot us a text or an email. We'll be happy to get on the calendar and talk further. So again, thank you everybody for attending. We hope everybody has a great day.